Hi everybody, Jeff Yastine for Total Wealth Insider. Do you want more proof that investing in the obvious is not so obviously great? We'll take a look at the much hyped ProShares decline of the retail store ETF with its ticker symbol EMTY, E-M-T-Y. It was considered pretty much a sure thing investment when it was launched in November last year. The exchange traded fund was supposed to profit mightily from the decline of malls and mall-based retailers. Instead, it's down 20% from inception and disappearing fast, by all appearances, into the abyss. On the other hand, if you bought perhaps Taubman Centers or Store Capital or Seritage Growth Properties on November 14th last year, when I suggested that the whole mall apocalypse, retail-amageddon aspect of the financial media had run its course, you'd be up 15%, 10%, and 22% respectively by now. And if you had bought the PowerShares Dynamic Retail ETF, the symbol is PMR, on February 13th this year, when I said that a brief sell-off from retail, I said, turned into an undervalued group of companies that turned them into a heavily undervalued group, you'd be up a tidy 13% in just 6 months. Now, what happened to this much maligned group of retail companies that many, like the ETF charts are indicating, are trading at all-time highs again? Well, I'll repeat what I said in November. There's no arguing that the U.S. is over-malled. Amazon has, of course, played a huge role in the downfall of malls that were, once ubiquitous, and the retail chains that were based out of them. But when asset prices fall to cheap enough levels, bargain hunters come calling, and that's what we've seen happen over the last year or so. Nordstrom, for instance, saw an online sales leap of 23% in the second quarter, and that's the latest in a string of steadily improving digital numbers for that group. Yet as recently as November, Nordstrom stock was trading at a price to earnings multiple of 11.7. That was its lowest stock valuation in a decade. Likewise, Walmart stock jumped 60% between January 2017 and January 2018. And no wonder, the shares had a price earnings multiple of 13. That was its lowest valuation in nearly 20 years. And that was before the shares rode higher, as everyone realized that these big companies, these big retailers, can do online sales every bit as smartly as Amazon can. So if you're an value investor, you see this happen time and time again. Individual companies are turned into Wall Street roadkill. Entire sectors are written off as yesterday's news, and given the old heave-ho by institutional investors, pension funds, hedge funds, mutual funds. Yet if you pick carefully among the bargains, it turns out that there's plenty of life if you know where to look for value. As it turns out, I have two extreme value retailer picks in the Total Wealth Insider portfolio, and together this pair up nearly 70% in the last 8 months. Now, both have been growing online sales efforts, but what really made the stocks pop so much in such a short time is that they both had some of their lowest PE multiples since the days of the Great Recession, again, over a decade ago now. And no one, least of all strategists and the pundits on Wall Street, seem to know or care. The point is, it's hard to lose money when a group of stocks gets so extremely undervalued. All investors need to do is hop on board and ride the value train express a few more stops down the line, and then they can harvest profits. Remember to keep liking us on YouTube, on Facebook, and on BanyanHill.com. I'm Jeff Yastine for Total Wealth Insider.